Hello, good morning. Happy 2026 to everybody. Younger people in front, please. This is for your 20s and 30s, all right? Okay, I see all the younger people moving to the front. All right, thanks. So I've been running Dollars and Sense. I'm Tim. I've been running Dollars and Sense for about 10 years. And without fail, the most viewed articles usually in January is these two topics. Number one is going to the gym, right? Very popular topic in January. But then, as the gym will tell you, a lot of people sign up in January, but then by July, nobody is in the gym left, right? The other topic that is super popular is investing, right? Because everybody's New Year's resolution is, okay, this is the year I'm going to start saving more and also to invest more, right? So I'm sure most of you, I heard from someone today is like one of the most crowded day for the Invest Expo. So I think, that's right, the resolution really makes sense. So without further ado, I have three persons here from the industry. Gerald, I think Gerald, you have more than 10 years, coming to 20 years in the industry, maybe, okay. So Gerald used to be, he's currently running Beansprout, but before that he was from the industry. And then we have the youngest person on our panel, Demi. She is like you guys in her 20s, and she is a YouTuber who creates finance content. So we'll hear from her more. And then last but not least, Kenneth, who is the more experienced person from the industry. He's from Amuva, formerly known as 𝐓𝐡𝐞 𝐎𝐍𝐬. So before I start, maybe I just let them introduce not just themselves, but also maybe share with you guys what their first investment is in life. Kenneth, maybe you start first. Not sure if you can remember.
Okay, well, thank you, Tim, for that introduction. And I would say that I will probably represent the more vintage and perhaps a veteran investor among our guest panelists here. But if I were to go back to when I started investing, it was actually during the 1990s. And at that time, I think the market was actually a roaring stock market at that time, because if many of us can remember, in fact, there was a legendary investor by the name of Barton Biggs that coined Asia the Asian tiger economies. And during those years were the years that I actually came out of school and I started to make my first investment. And I thought to myself, wow, it's quite easy because everything that I invested went up. And then I realized that really it was a function of the timing, because shortly after I invested for a couple of years, then came June 1997. And I don't know many of us who may remember, 1997 was when actually there was an Asian financial crisis that actually kind of basically decimated the Asian currencies in ASEAN. And that led to a very, very deep bear market. So then I realized that actually investing is a lot more than just trading and investing. So I would say that for my first 2 years, it was very enjoyable. I learned about really how to make money. But then it became then one of trying to be more careful about risk and learning to deploy my investments accordingly.
Thanks, Kenneth. So that really is the then, that's then, right? The then part of the event. Let's talk about the now. So Demi, share with us your first investment and how do you start it?
My very first investment was actually in a bond in 2015 when I was age 19. I'm going to be very honest that it wasn't an investment decision that I made on my own. It was my dad who actually said, if I have money in the bank that I'm not using, go and buy the bond. And so I did. So that was, looking back now, that was a very pivotal moment, because now I know that whatever money that I have in the bank is like something that can be used to actually earn interest on. So idle cash sitting in there just makes me a little bit uncomfortable now.
That's a retail bond.
Retail bond.
SIA.
No, Fraser.
Okay. But how much do you need to invest?
So I put in, I think 7,000 back then.
Okay.
7,000 paying 3.65%
Right.
per annum. So every 6 months I receive something like pocket money. I didn't reinvest it, but the idea of earning money on idle funds actually stayed with me to this day.
Yeah, because when you say bond, I thought, wow, you got 250,000 somewhere.
No.
Okay, Gerald, what about you, man? You were from maybe you should introduce your background as well. Yeah.
Okay, I think I sit somewhere in between Kenneth and Demi. So I didn't start investing in the 90s, but that was when I got exposed to investing. So I think it was during the Asian financial crisis period and the period before then when I saw my parents trading in the Singapore stock market. They turn on the teletext at a point in time. Not sure how much of the audience today know what is teletext, but it's the equivalent of maybe where you check the share prices in this day and age. So we turn on the TV, check the prices on the teletext, and that was actually when I got exposed to understand what are stocks, what is DBS stock, what is SIA stock, and got to learn from there. I think because of what happened during that period of time, how they actually suffered some losses during the Asian financial crisis, when I decided what I wanted to study in university, I did economics because I thought that, it'd be interesting to understand how global developments can actually affect economies, affect industries, and affect companies and livelihoods. And after that, I became a stock analyst. Just to understand how these different factors will move share prices. So I was a stock analyst for 12 years. Kenneth was one of my biggest clients. And then after being an equity analyst for 12 years, I thought it's actually very interesting to understand how these perspectives can be shared with retail investors, which was when I started Beansprout in 2021. We are a MAS licensed investment intelligence platform, just sharing our investment insights with consumers in Singapore.
Gerald, I just want to ask you, I think a lot of people, I remember when we were young, I'm not sure if Demi can relate to this, we sometimes think that we don't have enough money because we don't earn a lot of money. But I just want to get your thoughts on that. Like, do you think it is important for people to save up a sum of money before they start investing? Or should they just do it, even if they have a bit of money, just start investing already?
I think over the years, one of the things I learned is not so much around the investing principles, how do you value a company, what makes a stock a buy or a sell, but to me, what I've learned is that it is very important to have the safety and security when it comes to investing. To me, what is most important is whether this investment gives me a peace of mind or not. So using that kind of framework, I think this is where just having sufficient savings provides me with the peace of mind when I go about my investing. I know that if I have my emergency funds being set aside, I don't need to sell down my investments. If there's going to be, say, a global financial crisis, I don't need to be worrying about my portfolio because I have the safety net coming through from my savings. I think that is why at Beansprout we have content relating to, say, savings account, fixed deposits. It's really just to provide that kind of safety net so that we can then invest with a peace of mind, which I think is very important.
Very well spoken, very well thought out answer. Demi, I just want to ask you, I think I saw some of your YouTube videos and I think one thing that I imagine a lot of people turn to your channel for is that you have very relatable content that the everyday person or the everyday young person in Singapore can relate to. So my question is, when it comes to investing, do you have any sense of what's the kind of topics that seems to resonate better with younger people? Because I think Gerald gave a really perfect answer, but I just think most of us are not that perfect person at the same time. What are your thoughts?
I think there's no one perfect way to start your investment journey at the end of the day. People watch my content because of the transparency I share when it comes to my money journey. So more than just talking about concepts, for example, I really just share whatever that I'm doing when it comes to my own investments. So I think that's what people actually tune in for on my journey, starting with maybe under $3,000 income, investing $50 to $100 to what it is today, the portfolio. Sorry. So I started out working at a corporate job, earning under $3,000. So when I mentioned earlier, it's more like people tune in to the relatability and the transparency that I talk about on my channel. Every month I invest $100, $200, then gradually grow it from there. But I agree with what Gerald said when it comes to a peace of mind. What is good for you isn't good for other people. For example, I don't like individual stocks investing. So I pick things like an ETF, for example. Yeah, I think everybody's journey is different, but when you kickstart your own journey, it's good to try out a lot of different things as well.
I just want to ask all three of you a question, which is, do you all think that it is important to learn first before you start investing? Or is it better to just start investing first, maybe a small sum of money, and then learn along the way? Gerald, any thoughts on that?
I think you definitely need to learn the basics first. So for example, what is a brokerage account? What's the difference between a stock versus an ETF? We need to know the basics to be able to get started on investing. But to me, investing is a journey of learning as well. I think that's one of the reasons for why Beansprout is called Beansprout, in that it's also growth in terms of the knowledge. And I think even for me, having invested for more than 15 years, actually I'm still learning along the way. So whether is it the questions that come through to us, or when I learned that I made a mistake from investing. So for example, after I started Beansprout, to move my portfolio from growth stocks towards passive income investing. So that to me is something that is new. So I have to learn things like what are T-bills, Singapore savings bonds, bond funds, because I think even after having invested for quite a number of years, those are things that you still have to learn along the way.
You need a passive income after you started Beansprout.
Yes, that's right.
That's the problem when you leave your corporate job. Demi, what do you think? Like, learn first, start investing first.
I think we can do both simultaneously. These days, we have platforms like, for example, FSM offers 0% ETF RSP. You can kickstart your journey with just like $50 a month. And so I think that's a good way to dip your toes, get it a little wet, and understand how it works. Then along the way, as you do that as well, learn what is actually good for you, what is your investment styles.
Kenneth, from the industry, can you actually say invest first without learning?
Well, I actually agree with my panelists. There is definitely a learning journey in investing at any point in time. But I would just break down a little further that we need to always compartmentalize. What I mean is you need to break it down, right? For perhaps a very more straightforward investment, perhaps like dividend investing, treasury bills, fixed deposits, things that are very safe, stable, you probably can start investing first because these are very safe instruments. But when things come to do with the Mag 7, the view on US stocks, the view on perhaps growth companies, growth stocks, perhaps you need to do a bit more research. For those, perhaps you take a bit of pause and you do a bit more research first. Maybe invest a little, don't put all the eggs in your basket. And then as your journey grows, then you start to become more confident as you invest accordingly.
Right, thanks. Kind of talking about products as well. I think for newer investors, I mean, Amova has tons of ETF listed on the SGX. So you're just talking about for newer investors what to get started in. Maybe you can share some of the ETFs that you think a newer investors can start looking into.
Okay, thank you. I think ETFs as a start is really a good investment product. It's a good part of any investment. Just as we have shared in our panel, there are many different investment instruments. Now, what do ETFs do? ETFs gives you good replication of indexes. So for example, if you like the Singapore stock market and you believe that the STI is the best measure of Singapore's performance, the ETF, for example, in our case, the Amova Singapore STI ETFs, gives you the very efficient way of replicating that index. If STI is going up by 20%, this would improve by 20%. And they do it also at a very low cost. And it's also very easy, very liquid, and very easily accessible by investors as well. So we think that the ETF exposure, number one, has to be liquid, very expressionable, and also at a very low cost. So we think, like, for example, the STI ETF that Amova manages is a really exciting product because it actually gives you the exposure for Singapore. Another ETF that I will also mention, if you like REITs, you like income, you like stability and defensive cash flows, we run an ETF called the Amova Asia X Japan ETF. It replicates what we consider to be the income-generating instruments or REITs in Asia. And I think that actually is a very good income product that can actually give investors at this point in time.
We thought about investing at home from the SGX, but I think a lot of younger investors these days, when they first think about stocks, they think about the international stocks like your Apple, your Alphabet, Facebook, and such Meta. Do you think, and it's kind of like a home versus away game, right? Because if you're a sports team, you want to play at home because you feel like you have an advantage at home. But it feels like some investors are, new investors might prefer to play away games. What are your personal thoughts on this?
Right, thank you for the question. I think I would say that it all depends on who you ask. If I'm a Singaporean, which I am, and if you look at really the vintage of my background, I have invested for many, many years. I think Singapore is very home to me because I understand the market. And I think for a good part of most here, I believe that we will also understand what we invest in. So in that sense, I believe for any pre-millennial, and perhaps an investor that has invested for more than 10 years, Singapore is home. Because at the end of the day, we are very familiar with Singapore, the high dividend story, the story of SIA, DBS. So with familiarity, then you give you a lot more confidence to being home. But then if I switch gears and I ask the millennial investor or a Gen Z investor, in fact, I had a conversation with my son, who is 26 years old, and I asked him, would you invest Singapore as a core part of your investment portfolio? He said, for what? He said that there's no growth in Singapore. There are no big growth companies that I like and I invest. And my son, by the way, he's a financial investor. And he is totally of the opinion that there is no reason to have a home bias. So I think there's a lot of education we need to understand to really understand what are you investing for. If you are an income investor, if you are an investor that is more focused on dividend yields, I would think that definitely home biases count. But if you are a growth investor, I would say perhaps some of the other markets would be more appealing.
Okay, Demi, as a fellow Gen Z to Kenneth's son, would you agree with him, or do you have another take on this?
I actually split my portfolio half-half. So half in Singapore markets, another half in the S&P, so US-based. So I think, like what he said, Singapore stocks are what we are familiar with. Then there's no foreign currency risk as well. And most of the time, people will choose either or. But I truly believe that you can actually do both and. Like explore the US, but at the same time, explore our local markets as well. Yeah.
Either or sounds really good. And I think we come to the end. So I'll just ask all of you guys one more question, which is that if you could give a piece of investment advice to your younger self. I know Demi is pretty young, but if you think about it, like when you first started, Gerald or Kenneth, when you first started in the 90s, what would be the advice? Maybe Gerald, you go first.
Okay, I think have this panel session, my key learning also along the way is that there's no right or wrong way when it comes to investing. I think what I shared earlier is, to me, what is most important is what gives you the better peace of mind. So if investing in Singapore stocks is what gives you the peace of mind because you're familiar with DBS, you're familiar with the property assets that are owned by the REITs, you may not be getting, say, as much return as the S&P 500, but if it allows you to sleep better at night, then go ahead with it. If you are someone who thinks that, okay, I am familiar with Apple, I'm familiar with AI supply chain, and I want to get that exposure through the US, you can do that as well if that is what allows you to feel that your investment portfolio is what gives you that peace of mind. So I think over the years, that is one of my key takeaways, and I think that is how I want to be framing my investment decisions at this point in time.
Demi, would you still invest that $7,000 into the retail bonds, or you take a different approach?
I would still invest and start with the bond first because of the low risk, the stability, and the passive income that it provides every 6 months. But I would tell myself to read this book called The Psychology of Money by Morgan Housel earlier.
I love that book.
I love that book. It's a really short book that really ingrained in me the mindsets that I have with money today. Not just like, YOLO and do everything, invest it all into the stock market. There were a lot of mistakes that I made along the way. For example, losing $10,000 in investing in something that I didn't believe in or understand. But that book taught me what it means to use money as a tool to build a life that I really want for myself. So I would say that would be the one thing that I'll tell myself to do.
The Psychology of Money, for those of you who didn't catch it. And Kenneth, the best for the last.
Well, a lot of investors will tell you to diversify. Why I say don't diversify. Don't diversify meaning don't diversify for the sake of diversification. Have conviction. Like what Gerald said, you need to know what you want to invest in. you need to know what you are in for, right? In every investment that you make, do your research, understand what you are investing in, what you expect from the investment, then make the choice to buy the best way to express it. Then you can obviously diversify your portfolio into perhaps my best Singapore fund, my best growth stock, my best income investor. Then when you have a diversified portfolio of different types, every individual investment should work for you. So you need to do the research to, don't just diversify because you want to spread out your risk, but do your research to focus on the diversification effect on just companies or funds that give you the best returns for your investments.
All right, thank you. And I hope this panel discussion has been useful for you guys if you are thinking about starting your investment journey in this year, or you just want to level up your game. All right, thank you so much, guys.
Thank you.
Thank you.